This is your LMAX Exchange technical update for Friday, June 16th, 2017. Euro dollar. So the market has come back down after trading up to recent 2017 highs, just shy of 113, and there is risk for additional setbacks, corrective declines if the market breaks down below 111.10. A break below 111.10, which is some short-term support, would trigger a double top on the daily chart, which would expose a measured move downside extension back towards the 109.25 area. Of course, that would still be corrective within what has been a broader recovery in the euro. And at 109.25, if we break down below 111.10 and head down towards 109.25, that would be an ideal place for the next higher low and continuation of gains up towards the next key resistance in the form of the August 2016 peak, which comes in at 113.67. When looking at the medium-term chart, there's plenty of resistance ahead up above 113.67 into the 115 to 117 area. So on a short-term basis, the pressure still remains on the top side while above 111.10, but if the market does break down below 111.10, it would open a more significant correction, exposing a drop back towards 109.25. Sterling dollar. So cable has done a good job of being well supported on dips below that previous resistance, now turned what was support at 127.75, that range high that had defined and capped the market for so many weeks and months after the market put in a plus 30-year low at 118.40 back in October of 2016. But the breakdown again has been supported in the 126s thus far. However, there is still risk for deeper setbacks and for the market to trade down towards the 125 area before it ideally looks to continue what is now a more constructive outlook following that breakout above 27.75, which exposes an eventual move up towards 135 in the weeks ahead. Ultimately, only a break though back below 23.60, the low that we had seen all the way back on April 10th, would compromise the constructive outlook for sterling dollar. Dollar yen. So dollar yen has seen an impressive bounce over the past couple of sessions after the market stalled out ahead of a retest of the 2017 low just ahead of 108. But while the market holds below 112.13, the pressure on even a short-term basis remains on the downside, and there is still risk for another topside failure and resumption of declines back towards that 2017 low. Overall, though, if we want to see a shift in the structure, a more significant shift in the structure to the top side, the market would need to take out that resistance going back to May 11th at 114.37 right here to really force that shift. And until we break above there, the overall medium-term pressure still remains on the downside. Euro Swiss. So Euro Swiss is trading back in the 108s now after the market had stalled out ahead of 110, that critical psychological barrier, and the risk from here remains on the downside and for an acceleration of declines back towards some critical support in the 106s. We would need to see a clear break above 110 to force a meaningful shift in the structure. Aussie dollar. So Aussie has traded up back above 76 in recent trade this week. That's a key resistance level on a medium-term basis, and it'll be interesting to see how the market responds at current levels. If the market is unable to establish a close above 76, it does put the pressure back on the downside, exposing a more immediate drop towards that recent support that we saw on the 9th of May around 73.30. If on the other hand the market is able to establish a close above 76, it would suggest that the market could be poised for a retest of the 2017 high at 77.50. Dollar CAD. So dollar CAD has seen some intense setbacks over the past several days, setbacks from that 2017 high that was posted back in the month of May at 137.94. But overall, this is a medium to longer term constructive trend, and so setbacks should be very well supported in favor of a continuation of gains. Right now, look for that recent low that was seen this week down around 131.65 to support the market in favor of the continuation of that gains up back towards 137.94. If, however, the market cannot hold on to the gains right now that we've seen and breaks back down below 131.64, it would open and expose a drop down towards psychological barriers at 130. But ultimately, while the market holds above 130, the overall outlook continues to be quite constructive despite the latest intense pullbacks that we've seen. Kiwi dollar. So the New Zealand dollar has recently traded up above 73, but has stalled out ahead of that 2017 high at 73.76. Overall, this is a market that continues to show signs of being well capped into rallies, and so there is risk for a resumption of declines back down towards and below that 2017 low that was seen back in early May at 68.18. At this point, it would take ultimately a break back above 73.76, that 2017 high, to negate the toppish outlook for Kiwi dollar. SPX 500. So with the S&P 500, the market continues to show signs of trading to fresh record highs, and the break that we saw several days back above 2400 has exposed that fresh extension towards 2480 further up. At this point, on a very short-term basis, we would need to see a break back below 2400 at a minimum to take the immediate pressure off the top side, but a break below 2320 would be required to force a meaningful shift in the structure. Gold. So gold has been a very constructive chart over the past several months, and despite this latest pullback, the market is expected to be supported again in favor of a continuation of gains through the 2017 high around 1296 and towards the 2016 peak at 1375 further up. So any setbacks that we do see from here should ideally be supported in the 1230 area in favor of a continuation of gains. Only back below the previous higher low around the 1215 area would compromise the constructive outlook for